they should pretty much know this, is not obvious, right? And I'm gonna be a little bit, little bit blunt here. People come in and they might have the credit and they might have the job, but they have no funds. They have no money, right? And I I don't know who told them that they can buy a house with having nothing in the bank, right? Or people would actually apply, with funds and credit, but they have no job. They're trying to buy a house with unemployment, right? So based on the conversations I've had, and I'm talking about my entire career, this is not that obvious because people apply and they don't have everything together. Okay, so again, I'm going to do a deep dive on this part of my presentation, and I really believe it's the part that everyone should know before they even apply, right? And it's sad to me because they don't, right? And it's not their fault. It's just they don't teach it in school, and no one's really telling them. The research online is mostly advertisements. So like you're trying to find out how do I qualify for mortgage, and all of a sudden you're on a website that's trying to get you to apply for mortgage, right? And I'm trying to provide, this is why I call it Homebuyer Secret, my class. I'm trying to provide content so that you don't have to talk to a loan officer, and you'll be still well aware and prepared as to what it is to buy a house. So income, usually 2 years of consistency, and then assets, which has to be sourceable, and credit, which must be a hard inquiry with the lender. So let's talk about income first. Uh, a job that is consistent. When I say consistent, I'm saying that you don't have like 20 jobs in 1 year, right? Uh, we can still qualify people in that. And I've actually qualified someone with like, I think 8 jobs in the last few years, which is insane. But you want to be consistent and you want to be able to trace back at least 24 months of income. Now, let's say you, I don't know, maybe you became a stay-at-home mom, right? Or maybe you left your job because you were pregnant, right? Uh, Even though there was a gap, if we can trace back before that 24 months, we can still give you credit for that, right? We might need a letter of explanation or whatever, but it makes sense, obviously. If you're pregnant. Now, there might be other reasons why you're not working, like maybe uh, the company you work for, they shut down. Maybe COVID made it so that people were no longer allowed to show up to the office or whatever, and there's some sort of job gap. As long as we can trace back 24 months and we can explain that gap, it's still okay. So when I say 2 years consistency, or consistently, I'm looking to trace back 24 months, even if there's job gaps involved. So I might be asking for 3 years worth of information because you have a job gap, right? But if you have a job, then that's step number one. Now, the type of job also makes a difference. Okay, so let's say you were uh, a ballet dancer for 5 years, and then you decided to become a pizza maker, right? And you've been a pizza maker for only 6 months. We would have to take a look at that. We would have to have a conversation, but it doesn't have a consistent or similarity, right? So the opposite would be, let's say you were uh, a, a medical assistant for 2 years, and then you graduated college and you became a nurse. Well, that's consistent, right? Well, in college and school is a different conversation. So maybe that was a bad example. Let's just say you went from a medical assistant to a surgical tech, right? A surgical technician or scrub tech, right? It's still kind of in the same industry. So even though you started that job a month ago, if you have 2 years in the same kind of industry, we can still consider that consistent. Okay. Now about the school thing, and a lot of people get surprised. I was surprised when I first heard this, but we can actually count school as part of your work history. So what I mean by that is, let's say you just graduated and you are now, I don't know, a pharmacist, right? And you've only been a pharmacist for a month. Well, you've been in pharmacy school for the last 2, 3 years, whatever. we can actually count that school as being a part of your work history. So even though you haven't been generating income for 2 years, you've been in the industry for 2 years. So we would need like transcripts and such, but we can actually possibly count that as work history and qualify you, even though you've only been in the workforce for a month. Okay. And a lot of people didn't know that. I didn't know that when I first heard it, so I thought it was pretty cool. So that's how a lot of these people who just graduate, whatever major or school that they just graduated from, get a house right away. They were able to achieve that because they have the history based on their school. It's consistent. So I have Beth here raising her hand. What's up, Beth? How can I help you? That is a very good question. I'm not 100% certain, but I'm pretty sure it would work. Okay. And I would assume that if you're a part-time student, maybe you are working on another job, right? Maybe you're working to pay for that, right? Then that would actually probably strengthen the situation. But I don't know the answer to that. I'm going to make sure I notate that, and I'll email the answer to everybody on the call, right? But I'm glad you asked that question. That's a great question, and I should know the answer to that. But my assumption, and again, and I may have a disclaimer on all my calls. Sometimes I don't know everything, so I have to do some research. My assumption, again, disclaimer, I'm not sure, is that it would count because you're still working towards that part of your career. You know what I'm saying? So yeah, I think it would be silly, and again, this is common sense, but I don't know if it's true. It would be silly if you only took school for 6 hours instead of 12 hours, and you did for 2 years, and they're like, oh well, we can't count that because you've only been part time school. No, you were still in the career. So hopefully that makes sense. But yes, I will definitely find out for you, Beth, and I will give you the information as soon as I can. Okay. So thank you for asking that question. That's a great question. Uh, Self-employed and business owner, this is a really uh, this actually could be a class in itself, and I really don't want to get into that just yet because I know that's going to be the longest part. So let me kind of skip over that real quick and go to the rest of the types of income you can get. Retirement, which is like Social Security, maybe you're getting a pension. I mean, obviously it's consistent, there's proof. Yes, you can qualify with that. Okay. Child support and alimony. The thing about child support and alimony is it has to be consistently being paid. So let's say you have someone who's supposed to pay child support, but they haven't been paying it. Even though it's owed to you, we can't count that because there's no consistency there, right? I mean, we know when it comes to right and wrong, you should be getting paid that. And you should get credit for it, but because it's not consistent, that just means that your employer, in this case, it's the person paying child support, is not paying you, so we can't count that income. So there has to be a history there, okay? Just like any kind of job. I mean, if you were working for a job for a year, you're not getting paid. How can we think that you're going to be able to afford the mortgage? You don't have proof of paying. Same thing with this kind of income, right? Asset depletion. This is something that I just learned about. Well, it's been a couple of years, but it was pretty cool to me. Like I had a person who had no income, well, no job basically, but they had plenty of assets, right? And they were moving from one state to another state, and they were not excited about finding a job until they finally moved. So basically, they want to qualify, move first, and then go look for a job, instead of actually trying to have a job first and then qualifying, right? So they were trying to do it backwards because for the most part, we can't qualify you to move to another state if you don't have a job, right? But this person was like, well, I don't want another job because I'm not ready to find another job, but I have plenty of funds. And we were able to figure out a way to use the assets they have to qualify him with some sort of income. And I think, it involved like a CPA and a financial advisor, but we were able to qualify them based on assets alone. So no job, but he had the income to support paying a mortgage. Okay. And then there's also any kind of additional income, second jobs. Let me tell you about second jobs and overtime and bonuses, right? Because this is important. This actually kind of covers a lot of the different job or income qualifying questions. If you have a second job, if you don't have at least 2 years consistency on it, we can't help you with that. Like meaning you have one job and you have two jobs. you've done this one job for 2 years and you did this one job for 6 months. We can't qualify you for the 6 months. We need 2 years worth. So we can't count the income. Okay. And not that we don't want to help you, but we don't know if you're going to continue doing that for the next 2 years, because remember, we're making a 30-year bet off of 2 years of information. Okay. So if we have 2 years of information and you only have 6 months of part-time, how do we know that you're going to actually keep on doing that once you get the mortgage, right? So 2 years is just the minimum, and they probably should make it more, because again, we're making a 2-year bet off of 30 years of free. They probably should make it 5 years, but in order to make things possible for people to buy a house, they only have to have 2 years. Okay, so self-employed, you have to have 2 years in order for it to count. Same thing with bonuses, and same thing with overtime. Okay, with bonuses, if you, let's say you went from a job where it was all salary, like a regular wage, and then you went to a job where they reward you for performance, whatever. You're still getting the same salary, but now you're getting extra, I don't know, 25% in income because of your bonuses. But you've only been in the job for 6 months. Well, we don't know if that's going to continue, right? We don't know if let's put it this way: we don't know how long you stay in this job that gives you the bonus, because maybe performance-based work is too stressful for you and you don't want to be in that job anymore. You want to go back to a regular salary. So we don't know. So we need 2 years to know that you're willing to go through that consistently, right? Again, 2 years is just kind of the rule of thumb. Same thing with overtime, right? And why overtime is important. And let me explain why overtime is kind of unique, because you might have a job where you've been getting the same pay every single day for the last 50 years. And then all of a sudden overtime's happening because maybe there's a lack of staff members, or maybe they've increased their workload because their business is growing. We don't know if that's going to continue for 2 years. So if you don't have 2 years, then we can't qualify you for that, right? So that's why we must see it on record. Now, another caveat to bonus and overtime is that it must be verified by the employer. We call it a VOE, Verification of Employment, which literally involves us sending a document requesting information from the employer directly. Okay. And it's an official thing. So it's not like I call them and say, hey, Jane is working for you, da 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 da. She gets bonuses or she gets overtime. Do you expect that to continue? Oh, you do? Okay, cool. Click. That's not how it works. It's an official document and it's written down. Is written down and is signed, right? So it becomes official, right? So it's a kind of document that an underwriter is going to use to qualify you or disqualify you, right? So not only does your bonus have to have 2 years of history, or your overtime has to have 2 years of history, but it has to be verified that it's happening and verified that it's going to continue. Because let's say you've had 2 years of bonuses, and then we ask the employer, is this going to continue? And the employer goes, you know what, we're probably going to stop the bonus structure starting this month. Then it's no longer going to continue. We can't qualify you for that. Okay, so there's more to it than just what you think you're getting. We have to verify it, right? Now, this kind of brought up something in my mind that I don't have in my presentation because it's a little bit more complex or a little bit more specific or unique, but it's been happening a lot. A lot of people are starting to buy houses away from where their headquarters at, or where they work from at. So what I mean, for example, is I'll have a client who's working in California. Their job is in California. Their boss is in California. Their entire situation is in California, but they get to work from home because of quarantine or whatever, right? And it's gotten to the point where it's a permanent thing. Before it was a temporary thing, but now it's like, okay, you know what? Are you willing to take less pay, but you get to work from home? You don't have to come to the office anymore. And a lot of people are saying, yes, I'll accept that. So they are permanently working from home. Sorry about that. They're working from home. They're not going to the office anymore, and they're not required to come to the office. Now, why is this important? Because a lot of these people who are allowed to work from home are deciding to buy in other states, because even though their headquarters or whatever is in California, they can live in Texas and still do their job because they're working remotely. Okay, so that is something that needs to be verified as well, right? So if a person is moving from California to Texas, one of the questions I ask is, okay, so do you have a job lined up in Texas? And they'll be like, no, I'm keeping my job that you're seeing right now, but I'm allowed to work remotely, so I'm going to be allowed to move to Texas with no issues. And I have to verify that with the employers. Hey, Mr. Employer, Jane is going to be moving from where she's at right now to Texas. Are you okay with that? Will you still maintain her employment because she's in another state? And they have to literally say yes. We are allowing them to work remotely. We don't care where they live. They can still do the job, so it's fine if they move to Mars if they wanted to, as long as they can do their job, right? So that has to happen. And I wouldn't say I lost deals, but I've had deals where the client thought that they were able to work remotely, but then when we verified it with the employer, they're like, no. We want them to be still in the same location, vicinity of our business. So no, we are not going to sign off on them living in another state. We had to restructure the loan. Turn into a second home, whatever. But we still worked it out. But again, that is an important part of working from home and wanting to move out of state, which is a trend. I mean, I call it a trend. I called it a trend a year ago. It's more like a norm now. It's almost like there's a whole niche of that constantly happening, right? I'm kind of telling you guys this because take that into consideration. You might want to expand your sphere or your marketing, especially if you're really good at relocating, or you're really good at being able to sell houses remotely, right? You might want to consider talking to people who are considering moving to your market who might not be in your market right now. Because let me tell you this: a lot of people who are those kind of clients, they find me on Google and Yelp because they don't have a go-to person. They don't have a real estate agent or loan officer. So they're like, okay, I want to move to Dallas. Let me search who's the best loan officer in Dallas, and they find me, right? So making yourself kind of searchable or available in that aspect might actually bode you well. Again, at least one or two deals a month falls into my lap that way. Okay. So that's something to take into consideration. Now, I'm going to talk about self-employment. Hopefully I don't spend too much time on it because we're already on 28 minutes on this call. Plus, 5 minutes I was kind of messing around in the beginning. Self-employment, the way I handle that is I ask, do you have 2 years of tax returns? And if they say yes, I'm like, great. Did you write anything off? If they say no, I'm like, okay, great. How much do you think you make? If they tell me, I'll take that as is, right? So if they say I made $100,000 last year, I made $100,000 this year, or whatever, I didn't write anything off, I have my taxes. I'm going to take their word for it. I still need the tax returns to take a look at it, but I'm not going to stop everything, right? Now, if I go, do you have 2 years tax returns? Yes. Did you write anything off? A little bit. Okay, you know what? Let's stop the conversation. I need to see the tax returns. There's no qualifying you anything until we calculate your income, and we have to do that by looking at your tax returns. Okay. So that's kind of where I kind of stopped the conversation, because there's no way I can have an intelligent, result-driven conversation with a person about their tax returns and how they did it and how much their income is if they don't know all the details or they wrote stuff off. Then there's no way over the phone I can figure out how much they qualify for. It would have to be required a strong, deep dive review of their tax returns. Okay. And of course, their assets as well, or not assets, liabilities. Okay. So it's a hard stop. Now, if I go, do you have your tax returns? They're like, oh, no, I kind of got paid under the table. There's no reason for us to talk anymore. Okay. I'm self-employed, but, I've been getting paid cash. Is it okay if, is it okay if is there a way to show you my check stubs that I got from my jobs? The reason why the tax returns are so important is because you're officially telling the government, IRS, how much you made. And that's what we used to qualify you, what you told the IRS. So the joke I make, which, is I'm actually serious, is if you want credit for your income, you got to pay your taxes, right? You can't avoid paying taxes and try to get a job. Like, this happens all the time. This is why I'm kind of harping on this. You can't tell me you make $100,000 a year and you write off $100,000 in losses, right? In my perspective, when I look at your tax returns, you make $0. I actually had a person, and this is a real applicant, who made $5,000 a month. That's what he told me, right? We looked at his tax returns, and he recorded in $5,000 a month is $60,000, right? And I don't remember the math, but it came out to average how much he recorded in losses, $6,000 a month. So the guy was actually making a negative $1,000 income a month. And he was upset when I told him that, I couldn't qualify him based on his tax returns. He's like, why not? I make $5,000 a month. I'm like, yeah, but you also write off $6,000. So on paper, you make nothing. You're actually in the hole. I don't even know how you're on the phone right now. You probably don't have. You shouldn't be able to afford a cell phone, right? Of course, people write off whatever, right? He was a taxi driver. Okay, so when it comes to the self-employed, it's almost like I need to get more information from you, and sometimes people don't know. People go, okay, well, I did my taxes. Did you write anything off? I don't really know. My CPA can handle it. Then I'm like, okay, well, then there's no reason for us to talk on the phone anymore. Let's just look at the tax returns. Not that I'm trying to cut them off or make them feel like what they're going to say is not important. It's just what people think or say has always been different from what I see in the tax returns. So it's almost like if you want to do this fast, just give me your tax returns. We'll get down to the bottom of it. The truth will set you free. Okay, clarity comes with the documentation. So let's just take a look at that. Okay, now there's some exceptions. So I had a person. I actually closed a loan. I think like in November, where they had only had 1 year's of tax returns, but they've been in business for over 5 years, right? So it's kind of weird. Why do you have all your tax returns this year but not last year? Who knows why, right? I mean, I'm a business owner as well, so I understand. But for whatever reason, he only had 2020 tax returns, but he didn't have anything else. Uh, Based on that, we can still qualify them. Okay, we it, it takes the underwriting system and maybe even a manual underwrite or a physical review from the underwriter. But we can possibly qualify someone with just 1 year's tax returns as long as they've been in business for 5 years. Okay, and they have to prove that, right? Another example is, let's say you wrote everything off in 2019, and right now we're in 2022, so 2019 would actually work. If you wrote everything off in 2019 and you made $0, but you made $200,000 in 2021, we might be able to average it out and make it so that you qualify at $100,000. But let's say you want credit for $200,000 because you want to buy a bigger house, right? And $100,000 is simply not going to do. We can actually still qualify you on just the one tax return. So even though you have both tax returns, instead of looking at both of them because one of them shows a big loss, we can be like, okay, well, let's just look at this one and still qualify you because we only need 1 year's tax return is because you've been in business for 5 years. So that's a possibility. Okay. So again, the self-employed part, business owner part, it's a little bit more complex. So again, that could be required another class, and I don't want to bog the video down or the call down on just self-employed. It's just about tax returns and what you have on paper, right? If you don't have anything on paper, you got to start. That's my advice. Okay. All right. So let's talk about assets. Now, assets is going to be a little bit simpler. And I put gift funds first because that's the one thing that I don't think is apparently obvious, right? Gift funds is funds from another person, mostly or most of the time a relative, that they are willing to donate to you so that you can use that to put down on a home or pay for cost, whatever. Okay. We call it a gift fund because you really can't borrow money for a down payment, right? Like it can't be borrowed. Now there's some exceptions. I think the VA loan actually has an exception, but I don't want to talk about that. Okay. I just want to say the general rule of thumb, 99% of the time in a situation that you're in, you're not going to be able to borrow money as a down payment. You're going to have to actually have the funds yourself. And when I put sourceable, it's what you can prove. Okay. Sourceable means I'm going to review your bank statements or whatever statements you have that shows your money. And you have to have that funds already in the bank. Okay. So let's say you want to buy a house in February and you have nothing in the bank because you don't trust the bank, right? But you have $100,000 under your mattress. And you're like, okay, well, I'm about to buy a house in February. I better deposit my money to my account so I can show my funds, right? Because I know, I can't come up with cash, so I got to put in my bank account. So you deposit $100,000 in the bank account. Okay. When we look at your bank statements from January and December, we're going to see that you had $0, and then we're going to see you had $100,000 and you made a $100,000 deposit, and the underwriter is going to ask you, where did this money come from? Where did this $100,000 come from, right? And if you're like under the mattress, then we're like, okay, sorry, we cannot source it. because under the mattress does not tell us where it came from. So therefore, we cannot qualify you based on these assets. Okay. Um, so that's why we say the cash is not king. Okay. Now, if it's seasoned means, let's say you knew that you're going to buy a house in February and you made the deposit in November. Okay. So again, I ask for your January bank statements and your December bank statements. I don't ask for your November statements because I only need 60 days. I'm going to January, I'm going to December. The beginnings balance on December is $100,000 and the balance is still $100,000 in January. From my perspective, those funds are sourced. They are seasoned. I don't know where that $100,000 come from. It's always been there. From my perspective, it could have been there for the last 10 years. I don't know because I don't see any activity involving the $100,000. You see what I'm saying? So that's the difference between seasoned and not seasoned and sourceable and not sourceable. Okay. If I look at your bank statements and I see a deposit, I'm going to ask you where the deposit come from, especially if it's cash. And that's meaning it needs to be sourced. If you can't source it, we can't use it. Okay. But if you look at your bank statements and it's been there, meaning there's no major deposits, and you have $100,000 beginning balance and $100,000 ending balance on both, then we can use those funds. Those are sourced. Those are seasoned. Okay. So that's how you kind of handle cash. Okay. And I'm not encouraging that. I'm just saying that's just how we're going to look at it. And, you might ask why? Why is cash not king? That's the Patriot Act. Just look it up. Okay. They just don't want people like funneling or laundering money into, like criminal activity or legal funds being funneled into a home. It's a whole thing, right? Just make sure your funds are in the bank before you start buying a house, at least 2 months. Because when I say 2 months, because we look for 2 bank statements, last 60 days. So if you're going to buy a house in February, deposit in November at the least. If you're going to buy a house in May, deposit by February at the least. Okay. All right. 401k, the reason I bring up the 401k because a lot of people don't realize that a 401k is a very strong option in making deposits, not making deposits, making down payments. Okay. In fact, the 401k encourages it by giving you tax breaks. They consider buying a house, I guess, like an emergency use of funds, whatever. So they allow you to draw money from the 401k to make a deposit. And we love 401ks because it's easily sourced. Like I can look at it, it's like, okay, yeah, you have the money, you're good. Right. And then, of course, when you transfer the 401k money to your bank account in order to send the money to the title to make the send the money to title to make the deposit or for make the transfer for the down payment or the closing costs, whatever, we can source that. That's easy, right? I mean, the paperwork will show us where the money's coming from, right? So again, the reason why I bring it up is because a lot of people don't realize that. Like, I talk to a client and they'll be like, "Yeah, I don't really have much set aside." I'm like, okay, well, do you have a 401k? Like, yeah, I have a 401k. Like, how much is it worth? Like, well, it's worth like $60,000. Like, $60,000. That's more than 20% down. So you're good, right? So that's why I bring that up. And the reason I'm bringing it up for you guys, a lot of you guys are real estate agents, is I'm not trying to tell you to go be a loan officer and qualify clients, right? But if you're talking to a client and they go, I would love to buy a house and this and that, the trouble is I have no funds. You're going to ask them, well, do you have a 401k? And they go, yeah. I was like, okay, well, if you have some money in the 401k, we might be able to use that. And that's information that they may never have heard before. Okay, so that's why I'm kind of bringing that up. And I talked about funds and savings and bank account. Again, if it's in the bank, we don't care where it came from as long as it's already in the bank. We don't see the deposit, right? And I actually have people who have money in investments, like maybe cryptocurrency, whatever. If you're able to transfer it and show it, liquidate it, then we can still use that, right? Crypto and all that is kind of another conversation. But just basically in general investments, I've actually qualified people based on that. Like, so they had nothing in the bank, but they had a portfolio or whatever, and I showed that. Then we can use that. Just we need that to eventually be transferred or liquidated into the bank account, right? And we have to, of course, source all that. Okay. All right. So, does anybody have questions about assets? Now, before I talk about assets, also income. Does anyone have questions on assets or income? I'm looking at the chat right here. No questions in the chat. Anybody? Oops. I'm actually just seeing if you guys are there. You guys just sleeping. There's a chance that everyone might be sleeping right now. Yeah, because I'm looking at everyone's non-cam. Oh yeah, go ahead. Hey, Haley. Okay, so just in case people don't hear the question, Haley, and I really like that question, so thank you for asking. Uh, the bottom line is Kaylee has a client who is contracted for 40 hours a week, so she does get a full time 40 hours, but it's contract, so it's like a 1099, and she's been having trouble getting approved. Is there a way to get her approved, or what issues may she run into? Right. The first question I would ask your client if they were talking to me is, have they been doing it for 2 years? Right. If they've been doing it for 2 years, then the next question I would ask is, have they been reporting their income to the IRS for the last 2 years? If they say yes, then I would be confident that we can do something for them. Okay. Now, of course, it has to be consistent, right? Like if the contract work is the same kind of contract work for 2 years, and she has consistent pay, and she's been reporting her income, and she's not writing everything off. I personally don't see why not. Now, I might be wrong, but I've actually helped people in that scenario before. A lot of nurses are like that. A lot of nurses, they're how do I put this? They're travel nurses, right? So they'll work for this hospital for like 6 months, and then they'll go to another city for another hospital for 6 months. And because of coronavirus, a lot of that's happening right now. And I've actually qualified and helped close clients who are in that scenario, and it's contract work. Even though they are a nurse, they're still doing contract work. They're 1099. You know what I'm saying? So they have different employers or whatever. You know, as long as it's consistent and we can see paperwork, and there's tax documents, I don't see why not. Yeah. So I would. I mean, I'm not sure what state you're in, but whatever local. North Carolina. Okay. Well, I mean, I can take a look at it if you want me to. Um, because I'm licensed in North Carolina. But if you are talking to a local lender already, I would just ask them, why is 2 years consistent income on taxes not qualifiable? I would ask them that question. And hopefully they have a good answer. Okay, so no problem. Let's see here. Any other questions? Okay, cool. So we're gonna move on to not that slide. Oh, that might be tomorrow's class, or not tomorrow's class, next week's class. I want to talk about credit. Now, credit, the reason why I save this for last, I save this for last because income and assets should be obvious. Like I said, if you're going to apply with me and you don't have a job, the meme that I made is this a mortgage application or a job application, right? Like, why are you showing up looking to buy a house when you have no income, right? Self-employment, I mean, not self-employment, unemployment is not going to last for 30 years, right? So to me, that's obvious. Assets, that should be obvious as well. But people hear a lot of different things about down payment assistance and seller concessions and all that stuff, and how you can buy. Let's put it this way: if you don't have, and this is kind of like my honest lender coming out, because that's the kind of class I like to teach. If you don't have any money in the bank, buying a house should be the last thing you should be thinking about, right? You need to be worried about why you don't have anything in the bank, right? And maybe because you're overpaying on stuff. Maybe you bought too much of an expensive car. Maybe you're renting a house that's too expensive. Whatever. I mean, basically, you don't have savings because you're overspending, right? So let's look at that first, and then figure out buying a house, because buying a house is a lot more expensive than most people think. Okay, it doesn't just come with a mortgage, but you also got taxes, you got insurance, you got HOA, you have maintenance, you got to pay for someone to mow your lawn, unless you're going to do it yourself. But that means you have to buy a lawnmower, right? And there's just so much more. And maintenance, repairs. I mean, there's so much more owning a house than what people think. So if you don't have savings, you're not ready. Okay. So that's why I kind of talk about income and assets in the beginning right away, because I think those should be obvious and common sense. Credit, not so obvious. Now, yes, there is a hard score that everyone's looking for. But even if you qualify based on the score, there's other things on your credit report that might stop you from qualifying. Okay, and this really could be again another class, but I'm kind of gloss over the basics. Okay, let's start at the bottom. You actually can possibly qualify with a 500 credit score. Okay, with 10% down. Okay, no one does it. And when I say no one, I'm talking about the general population of lenders are not going to touch a file below a 640 credit score, maybe not even below a 580 credit score. Okay, and I've only worked for 2 companies that has provided that, right? And one of them, I actually closed a loan where the guy had like a 530 credit score, so I was blown away, but it actually worked. Okay, but I don't work for that company anymore. And the company I currently work for Van Dyke, they also do that. Now, I'm going to give you a disclaimer. When I asked the head of underwriting about it, he said, no, absolutely not. We do not do those loans. But then on the side, like privately, he asked me, what is the loan number? Let me take a look at it. And that told me that there are exceptions, right? So 500 credit score with 10% down. Now, you would have to be like magically perfect in every way, shape, or form if you're going to try to buy a house with a 500 credit score, right? Um, and of course, most people who have a 500 credit score don't have 10% down, right? But sometimes there's exceptions. There's that guy or gal who, for whatever reason, screwed up, a payment or something like that, or maybe a car got repoed, whatever. But they got plenty of funds and they decide not to make their payments or whatever. So there's a chance that might happen. So in that case, I would tell you that it would be probably a manual underwrite. It will probably actually manual underwrite, but it would require a lot more work, a lot more time, and probably not worth considering, right? But it's possible. So that's why I don't turn anyone down. I want to look at everyone's information and just see what the realm of possibilities are. Okay. But again, I don't really promote that. I don't tell people, hey, 500 credit score, go and apply with me. I don't, you're probably going to be disappointed in most cases, but there's a possibility. Okay. And I'm going to pause real quick because Beth is raising her hand. So I'm going to go ahead and hold on real quick. Yeah. Mm-hmm. 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 Yes, absolutely. It's one of the most popular things that I do for my clients. Okay, and the fact that you have lenders that do that, you're blessed because not very many lenders want to do it because it costs money. And what I mean by that is actually cost a fee to do a rapid rescore. It costs a fee to do what we call what if scenario, a wayfinder, where we actually use the credit report to kind of manipulate the facts to see what the scores might be if they were to do certain things. That all costs money, and we eat it as lenders. Okay, so I do that as well for my clients because I know better. I know that a lot of my clients are going to be, like you said, first time home buyers and they're just not ready, but they want to be ready. And I always want to provide clarity, which is why I pull credit, even though I know they might qualify because I want to give them, again, guidance, right? So, long story short, a rapid rescore is literally asking the bureaus to update their reporting on that particular trade line or account and making it so that it reflects the new information on the credit report. That's literally what a rapid rescore is. So I call it unnaturally manipulating the credit scores. Okay, that's why it's called a rapid rescore. You're actually literally what you're doing is you're rescoring and you're doing it faster than it's supposed to take. Because let's say it takes 30 to 45 days a uh, for a creditor to update the information, right? So let's say you make a payment, it takes them 30 days to update that you made the payment. Let's say you miss a payment, it takes them 30 days to update that you missed a payment, 30 days or more, right? A rapid rescore is saying, no, we're not waiting 30 days. We want it now. We want the new information to update it now. Now, why would you want to do that? Because someone like myself told you that if you paid this Capital One card from $1,000 to $200, you will jump your credit scores up by 20 points, right? So you do, when I tell the client that and the client goes and does it and the client gets a letter written from the creditor, Capital One in this case, and says, yes, Jane Doe did pay her balance to $200 on this date. You give me the letter, I submit it to the credit reporting company. I go, listen, we need Jane Doe's account on Capital One to be updated to a $200 balance because it's now paid down. Here's the letter to prove it. And then the credit reporting company goes, okay, I accept this request. I'm going to go ahead and connect with Capital One to make sure this is correct. And if it is, then I will force them to update the information and I will give you a new credit report with the new balance, which should lead to a higher credit score. Okay. It can take anywhere between 5 to 7 business days, sometimes longer, sometimes less. But that is what a rapid rescore is. And why do you do a rapid rescore? Two reasons, I would say. Number one, you are in a rush. You need to buy a house now and you need the scores now. Maybe you're already under contract and you want a better interest rate because right now you're getting not so great interest rate. But if you were to increase your score by 20 points, you might get a little bit better. Might be worth doing a rapid rescore. Okay, I've done that for my clients as well. But the second main reason why you want to do that fast is because credit is like a moving train. It's constantly changing, right? I would compare it to like watching my kids on a Ring video monitor. They're never in the same place at the same time. Okay. So that's how credit works. Okay. So why would you do a rapid rescore? Because you don't want anything to change. You want everything to be the same because it's telling you right now, this is what the control situation is. If you were to change this, then your scores will look like this, right? So this needs to change, but nothing else can change. So if you don't do that right away, then this can change, this can change, this can change, and then the advice they're giving you might not apply, right? So you want to do rapid rescore because you're basically changing something that's already steady, and you're changing this one variable and therefore increasing your scores. Okay, because obviously every single item on the credit report is a variable that can affect the overall score, the aggregate score, right? So we're trying to make a change, a tweak that we believe will get your scores up. So that's why you do rapid rescore. Uh, but did I explain it to you okay? I mean, I kind of gave you probably more information than you wanted, but yep. Yes, no problem. And if you do have clients that you want me to look at, we also have other down payment assistance programs that work really well at 620 credit scores. And I don't charge my clients to do a rep score. In fact, I think we're not allowed to. So to kind of address what you said, I don't know exactly what the lender is doing, but for sure there's going to be some sort of funds involved in getting the scores lower because you have to pay balances down. There's normally, I would say, 9 times out of 10, what the advice usually is: pay this down, pay that down, get this to a $2 balance, whatever. Right? That's usually the case. So that might be what they're addressing when it comes to having money or paying something for the rapid rescore. Right? Now it comes to paying for the fee to rapid rescore, whether it's doing the wayfinder or actually paying for the actual submission and the actual result of the rescore. Again, I was told that we're not supposed to pass it on to the client. So if the lender is passing it down to the client, then I don't know what to say about that. I don't know if that's compliant. I don't know. Maybe I don't know. Maybe they're different structure. Maybe they're a broker and brokers can do that. I don't know. Right. But just so you know, I don't charge for it. So yeah. Yeah. Hmm. Yes, ma'am. Of course, no problem. Any other questions about credit? Okay, so I'm gonna kind of try to finish up real quick because we're almost at the hour, and I don't mind staying here as long as you guys need me to. Q&A, I basically set it up so that I have nothing after my call just to field questions. Okay, so I'm in no way rushing you guys, but I don't want to be responsible for the call being too long. Okay, uh, so again, 500 credit scores with 10% down, which is very rare. In fact, I wouldn't want to even tell a person about it unless I look at the credit and they need it, and they go, well, I actually have 20% down. I'm like, okay, well, let's see what we can do, right? Maybe I'll actually do a rapid rescore with you instead of doing the 10% down and get you a better score and get you a better rate, yada yada yada. Who knows, right? So we'll see. Money does solve a lot of problems. Okay, so 580 is what's normally required for FHA. Does that mean that if you have a 580 credit score, you're automatically approved? No. It's just, and the way I want to explain credit, and a lot of people don't understand this, is just because you meet the number does not mean you qualify. It just means that you didn't get cut off. Okay, and that's the way I look at these numbers. It's a stopping point. So if you have a 579, I don't care what else is going on. I don't care. You might have the best job in the world. You might have $1 million in the bank. You're not going to qualify for an FHA 580, 3.5% down, because you have a hard stop, which is your score. Okay, that's the way I want people to understand and process what the credit score really means. It doesn't mean you automatically qualify. Because I've actually had people where they had a job, they had funds, and they had like a 620 credit score, and I had to deny them. They're like, "Why did you deny me? I have above a 580 credit score. I have a 620 credit score." I'm like, "Well, it's not just about the score. It's because of this and this and this, and there's other things. There's other nuances on the credit report or whatever that makes it so that even though everything else checks, this one thing is preventing you from going forward." Okay, so you have to look at the score as a cutoff, not an entitlement, right? So FHA is 580, and I've actually have closed people like at a 581, 582, so it's possible, but you're going to be fighting an uphill battle for sure. 620 is for conventional, but usually people who are conventional are more than likely going to be better off going to FHA. What I mean by that is a 620 is a very weak conventional, but a better than normal FHA, right? So you might want to consider the FHA loan if you're in that range, okay? But 620 is definitely the cutoff. But most lenders, and when I say most lenders, I'm talking about like everybody. I'm talking about banks, credit unions, the big box stores. Most of them are going to need at least a 640 credit score to even look at your credit, look at your application. Now, it might be confusing. Why do they have different credit qualifications or cutoffs for different banks? Fannie and Freddie, who is the overarching regulator of all loans, has their guidelines and what they're willing to do. That's why the 500 exists. That's why the 580 exists. Yada yada yada. Right? What lenders or banks or credit unions do is they add overlays. It's an unnatural restriction they decide to add onto their own qualifications for whatever reason. Maybe risk factors. Maybe they don't want to work with a particular type of credit score because it's too much work. I don't know, right? I don't know the reason why there's overlays. Okay, but they create overlays to basically prevent themselves from being in too much of a risky situation, right? Uh, a lot of the places I work pretty much don't have overlays. Like Van Dyke, where I work, if it runs on DU, which is a desktop underwriter, meaning the automated underwriting system, if it allows it, if it says approve eligible, then we can do it. I don't remember hearing anyone saying, even if we do it, even if it gets approved eligible, we can't do it. If there's ever a time where it happened, it would be a huge exception that's not being advertised or being taught or trained to us. Okay, so for the most part, Van Dyke Mortgage operates with no overlays. Okay, now that wasn't true about a year ago, maybe 6 months ago, where we had additional restrictions. Like, let's say someone was at a 580 credit score, we wouldn't allow them to go above 50% debt to income ratio, or maybe even not even above 43. Debt to income ratio makes a difference as well in terms of credit scores. Okay, so the natural guidelines say that you can go up to a 56%, 55% debt to income ratio on FHA as long as you have an approved eligible, meaning like you run the scenario, 580 credit score with actually it actually might be higher, 580 credit score with a 55% debt to income ratio, and it gives it approved eligible, we can run with it, right? Well, Van Dyke did at one point say, okay, even though it runs, they have to have at least 1 month of reserves, or 2 months of reserves, 3 months of reserves. Reserves meaning mortgage payments in the bank, not something that we're going to take from them. Reserves as in, like, when we finish closing, you have 3 payments in your bank still remaining, right? So let's say you have $10,000 and it costs $10,000 for down payment and closing costs, and you pay that, and you have no reserves, you wouldn't qualify. You have to be able to put $10,000 on closing costs and down payment and still have 3 months worth of payments, mortgage payments in the bank. That's what reserves mean, right? So that was an overlay that Van Dyke had at a certain point, but I think it was because of COVID restrictions or whatever. Anyways, it does happen for Van Dyke in some places, but um, we right now again have no overlays. But if you hear something different, what I'm saying is more than likely because of an overlay. Okay. And the reason I'm bringing overlays up so much during this time, because usually overlays are on the credit scores. There are some overlays when it comes to income and assets and all sorts of other parts of the qualifying part, but credit is usually where the overlays are the hardest. I'll give you another example of overlays. Some banks won't qualify someone no matter what their scores are if they only have one trade line, meaning they only have one credit card or one car payment. They need to have at least two trade lines. And maybe those two trade lines have to be at least 2 years old, right? So let's say someone got a credit card yesterday and the day before that, and they did a good job, and they've been using that credit card for for a good 3 months now. So now it's a 3 month old credit card, and they've been making perfect payments, and they have decent scores. Well, the lender might look at it as like, okay, you have decent scores, you qualify, you have the income, you have the funds, but your trade lines are less than a year old. I cannot qualify you based on this. Okay, that's an overlay that might appear. Okay, so credit is a lot more complex than just a number, which is why whenever someone asks me, do they qualify, and they tell me their credit scores, I'm like, well, I don't know until I look at your credit report. And if they kind of push back and say that I don't want to have my credit pulled, then I'd be like, well, then I can't give you good information. Well, why not? I told you my credit scores is 640. It's like your scores is not the only thing that we determine whether or not you qualify, and it doesn't tell us how much you qualify for, because also on the credit report is going to be your liabilities, which most people don't know on the top of their head. Like when I ask people, well, how much are you making how much are you paying on a monthly basis in terms of liabilities, in terms of car notes and credit cards and whatnot, and they tell me the number. When I pull the credit, it's always not accurate. Only time it's ever accurate is if the number is zero. I have no debts, I have no car notes, I have nothing. And then I pull their credit and it's true, they have nothing. That's the only time it really is on point, whenever people tell me what they think they pay on a monthly basis. But usually if they have something, if they have a credit card or student loans, whatever, the numbers don't match. So that's why I need a credit report, because I can't qualify you based on state information. And also, if you have a credit report from another lender or you downloaded a credit report or whatever, I can't use it because, number one, I don't know if that's a legitimate credit report. Not saying that you're a criminal and you would actually make changes or adjustments, or fraudulent documents are provided to me from you. I'm not saying that, but I'm saying that we can't guarantee that. So that's why we have to pull our own credit report. But also, in order to qualify, I have to run you through the underwriting system, which requires a credit report inside the system. So I can't take your paper or screenshots, or even if you have a file like a PDF or whatever, even if I have a file, I can't take that, import it into my system. It doesn't work that way. I must do my own credit report. I must have my own inquiry. Okay. And before I actually end this part of the conversation, I do want to say that anything that you find online through your bank, through third-party consumer reports, Credit Karma is one of the ones I like to talk about. None of that is going to be what we see, right? And it might be the same, but it's not measured the same. So if it's the same, it got lucky, because Credit Karma might be like on a 900 scale or whatever, and we're on an 850 scale. The numbers might be exact. It's not because they both have the same information. It's because the numbers just coincidentally matched. Okay, but there's actually documentation out there by officials who regulate the mortgage industry and regulate credit reporting and such, and they literally say anything that a consumer buys in terms of the credit scores cannot be used to judge how a lender would actually see it when they actually do an inquiry. And that's really the major difference. So you understand why what you see is different from what I see. Because what you see is not an inquiry. You're not inquiring for your credit report. You're not talking to Mr. TransUnion and Mr. Equifax and Mr. Experian and saying, hey, I'm Jane Doe, I want my credit scores. You're not telling them that. You're trying to do a soft pull, is what they call it. To me, there's no such thing as soft pull. It's an inquiry and non-inquiry. You're doing a non-inquiry to try to get what information you can about your possible credit scores. But again, it's not evidence of what your credit score actually is. Okay, what's evidence of credit scores is what I get whenever I inquire from Mr. TransUnion Equifax and Experian. Hey, Mrs. Jane Doe is trying to buy a house. Here's information. I need her credit report. And they go, oh, Jane Doe is trying to buy a house. Okay, well, we know now because you inquired with us. You made us alert. You've notified us that Jane Doe is trying to buy a house. So we are going to ding her. And we know for a fact that she is looking to buy a house. But here's information that we have in our database. Here's information we have in our bank, our files, right? So that was a trade. Like I go, hey, Mr. TransUnion Equifax and Experian, can I please have Jane Doe's credit report? And they go, okay, well, it's going to cost you because I'm charging you, Larry, but I'm also going to ding Jane Doe. But here's the information. That's an inquiry. They know that's happening. Whereas everything else is not an inquiry because you don't know. I mean, even if you pay for it, you're not inquiring to the bureaus. At least you're not inquiring to the right bureaus. Now, there's a few exceptions, but just so you know, it's FICO 4, 5, and 2. So if you're not pulling FICO 4, 5, and 2, you're not pulling the right scores. Okay. So again, I'm bringing this up because credit is such a complex, such a convoluted, misinformed. Uh, there's too much to know to really know everything about credit. So it's just better just to have your credit pulled by a lender like myself and let us tell you what we see, what we think is the truth. Okay. So hopefully it makes a lot of sense. Does anybody have any questions on what I just presented or want to chime in or anything like that? I'm going to unshare real quick. Anybody? FICO 4, FICO 5, and FICO 2. FICO. FICO, yeah, FICO 4, FICO 5, and FICO 2. Yeah, 2, 5, and 4. If you go if you go to myfico.com, you actually can get a close reflection of what you think your mortgage scores are at. So you have to sign up for the actual service, and they'll actually show you a bunch of FICO scores. Like they'll show you like 20 different scores. Just gotta look for the one that says FICO 4, FICO 5, FICO 2, and it'll actually say for mortgages. And that will be a close reflection as to what we'll see. Yeah, and the best way to answer that question, because I get that question all the time, or I get that conversation all the time, Beth. Okay, the best way to answer that question, and I go, that's awesome that Credit Karma told you that you're 617. That means for the most part, you are doing a good job of maintaining your credit history. But just so you know, it's a third party that is giving you information based on aggregate consumer credit information, is not the actual inquired information that you'll get from the actual bureaus, TransUnion, Equifax, and Experian. And the only people that can really do that is going to be the lender. That's why it's going to be different. So just want to set expectations. Maybe the scores will be higher, maybe the scores will be lower, but just so you know, it's not the same exact thing. And I tell them that to, number one, kind of kick them in the butt a little bit to let them know that they're operating with bad information, but at the same time, show them that it's okay that they're using this information because it's a guide, right? It's sort of a map, right? Even though in my video I said it's the wrong map. It's still a map, to kind of give you some sort of guidance. Actually, you know what? It's not a map. Let's put it this way: my credit report is a map. Your credit report is a compass. It's telling you to go north, south, and west, east, but it's not telling you exactly where to go, right? So I would compare it to a compass. So it should be called Credit Compass, not Credit Karma. So yeah, I appreciate that question, Beth. Any other questions? Okay, so before I end the call, I do want to invite you guys to maybe, if you want to, chime in on something that you took away. Like, what was your biggest takeaway from this call? Like, what did you learn, or what was your biggest aha, or what you think can help you in your future conversations, or if you are a client, what piece of information is going to help you the most in terms of buying a house? Does anybody want to share? That's okay. Probably everyone's sleeping right now. That's okay. So I really appreciate you guys being on this call. Obviously, I want to help anybody. So if you have any questions in the future, you always subscribe. I have a YouTube channel, Home Buyer Secret. If you go to homebuyersecret.com, you actually might be able to find it. So homebuyersecret.com. I also, do coaching for social media, but also for home buying. So you can always look me up. You can always Google me. But yeah, again, I really appreciate the opportunity to be in front of you guys and give you information about the home buying process. Next week, what I expect to talk about is, and I'm actually going to show you the slide real quick. Next week is, do I really need to be pre-approved, right? And I'm going to not only give the obvious answers as to why you should be pre-approved, but I'm going to give you the qualifying reasons why you should be pre-approved and why you really shouldn't question it. You should just go and do it, right? It's almost like, let's say you're sick. Do I go to the doctor and get diagnosed, or do I just kind of take whatever medicine that's out there? I'm going to show you why you need to go to the doctor and actually, get an actual diagnosis. So again, I really appreciate you being on this call. If you want more information, there it is. You can call me or text me anytime. That's my personal cell number, 832-606-2193. My email address is LLE, my first initial, and then my last name at VanDykeMortgage.com. You can check me out at LarryLee.com. There's some resources there for my classes on my YouTube channel. And again, you always Google me, Larry the Mortgage Guy. More than likely, if you put Larry Lee or Larry the Mortgage Guy in Dallas, you'll find me. Okay. But again, I really appreciate being on this call, and I will see you guys next week. Larry the Mortgage Guy. Yep, no problem. Thank you guys. And I'm Larry the Mortgage Guy. I'm out. Bye, guys. Hopefully, you guys heard the conversations. We'll see.